My proposal here is that the Fed should be paying, if that's the word, negative interest rates on excess reserves. That excess reserves at the Fed should have a negative interest rate, encouraging private banks to do something else with the money rather than holding it at the Fed, and then maybe the Fed wouldn't have to buy so many commercial assets itself. My last point is deposit insurance, which is a permanent but now much expanded in the crisis government intervention in the financial system. As we all know, in making good on its deposit guarantees, the FDIC itself is publicly admitted to be insolvent, that is to say, its liabilities exceed its assets. Hence, it wants all possible new capital available to banking forced into helping solve its failed bank problems. A better solution would be the opposite, to encourage, as a matter of national policy, new capital to form new banks, unencumbered by past losses, banks unencumbered by TARP investments, banks unencumbered by regulatory controls and interventions, would then be able to make available credit to enterprises and individuals which are creditworthy. I believe these ideas would help us move toward re-privatization of the financial system and at least having Leviathan lose a few pounds. Thanks.
Next, we'll hear from William Black, Associate Professor of Economics and Law at the University of Missouri, Kansas City, teaching white-collar crime, public finance, antitrust, law and economics, and Latin American development. He was the Executive Director of the Institute for Fraud Prevention from 2005 to 2007. He's taught previously at the LBJ School of Public Affairs at the University of Texas at Austin and at Santa Clara University, where he was also the Distinguished Scholar in Residence for Insurance Law and a visiting scholar at the Marcula Center for Applied Ethics. He was the Litigation Director for the Federal Home Loan Bank Board, Deputy Director of the FSLIC, Senior Vice President and General Counsel of the Federal Home Loan Bank of San Francisco, and Senior Deputy Chief Counsel, Office of Thrift Supervision. He was Deputy Director of the National Commission on Financial Institution Reform, Recovery, and Enforcement. Professor Black.
So you have two refugees from the Federal Home Loan Bank system sitting on the one end of the table. And I'm going to talk, Alex talked about the problems of deposit insurance. I'm going to concentrate on the uninsured portion and some of the problems that arose there. So this would be the mortgage bankers. So what do we know about the mortgage bankers? We know that they followed a simple four-step recipe. 1, grow like crazy. 2, make really bad loans. Those two are related. I'll come back to that briefly. 3, leverage up the kazoo. And 4, put no loss reserves, essentially no loss reserves, on the books. If you do those 4 things, you are mathematically guaranteed to report record profits. It's not a risk. It's absolutely guaranteed as long as the bubble is inflating. Now, why are the first 2 related? This is not iPods being newly developed, folks. This is a mature product. And so if I want to grow really rapidly, a few institutions can acquire, but that doesn't work for 350 mortgage bankers. So the standard way is to buy market share, and you buy market share by reducing your yield. In a market, what's likely to happen from your competitors if I reduce my interest rate on mortgage loans? They're going to do the same thing, right? And is that a good way to maximize accounting profits? Real bad way. But what happens if I grow by making loans to people who can't repay the loans? There are 10+ million of those folks easily available. So I can greatly expand demand. I can grow very rapidly, and I can charge them a premium interest rates. So I can both grow extremely rapidly and charge more. Now that is a really great way, as I said, to maximize short-term profits. What do I need to accomplish this? It creates a very distinctive pattern. I have to gut my underwriting standards. I have to change an organization so that the tone at the top is one of anything goes. That you get in trouble not from blocking bad loans, but from blocking bad loans. And that's exactly what, whenever we look at these mortgage bankers, we find. That the underwriting has been gutted, and that people were actively discouraged if they raised objections on loan quality. Okay. That produces something really bizarre in economics. Now, the genius of voluntary exchange is that it is typically a positive sum transaction. Typically, both parties are simultaneously made better off. And that's a pretty darn good system. If you suffered through economics, that was Pareto optimality, right, after an Italian economist. Here you had reverse Pareto optimality. Both principals were made worse off. How many of the mortgage bankers still exist? None, essentially. Roughly 350 died. So that principle was destroyed. How about the people they brought into the loans? Do we help people by making them loans they can't repay? There's been no greater destruction of working class wealth in the history of the United States than bringing the working class into houses they couldn't afford at the absolute top of the bubble. Right? They are virtually all underwater on their mortgages if they bought in late 2005 on up through 2007. And we managed to demonstrate Gresham's law in a really perverse way. So we have good studies on what happened with appraisers. I told you we had to gut the underwriting. Your secured lender, tell me the honest reason for deliberately inflating an appraisal if you're a secured lender. Tell me why that's in your interest if you're running any honest shop. It not only itself an act of fraud, but it's only done for purposes of fraud as well. And the latest studies show that 90% of appraisers report being pressured to inflate appraisals, and that 62%, I think it is, report that they've actually lost fees and business because they're refused. Note that you don't have to get everyone to inflate appraisals. If 5% of the appraisers are willing to do it, we simply give our business to that 5%. Right? And that Gresham's dynamic existed in the accounting profession, and indeed has existed for a very long time, such that the savings and loan debacle, they were always able to get clean opinions. The Enrons and the WorldCom, they could get clean opinions. And note that they go to the top-tier audit firms. The mortgage bankers get clean opinions while following these utterly insane practices every single time. Right? And that Gresham's dynamic not only hurts, obviously, economically, but in terms of any traditional value of a Federalist society, fraud is not one of those traditional values, right? It brings down the entire moral tenor of business. So the question is, this isn't deposit insurance, what makes mortgage bankers consistently across the nation for the better part of a decade make loans that were going to destroy the institution? And how many would agree with me that this is strong evidence of the actions of the Community Reinvestment Act? How many? How many people disagree? Alex, what's the trick? How did I start my discussion? How did I start my discussion? I'm talking about mortgage bankers who do not receive deposit insurance. How many of them are subject to the Community Reinvestment Act, folks? And they all did this. So you need an explanation if you're going to attack the Community Reinvestment Act that explains why 80% of the loans, the subprime loans and Alt-A liars loans, were made by this portion of the market. Thank you.